Ever wondered why the money in your pocket might be worth more or less than, say, the money someone in Japan uses? It all boils down to currency values, which are always changing. Understanding why these currencies have different values is important, especially when you're traveling, investing, or even just buying things online. One big reason currencies differ in value is inflation. Think of inflation as how much more things cost over time if a country has high inflation. Its currency usually gets weaker. That's because your money doesn't buy as much as it used to. On the other hand, if a country keeps inflation low, its currency tends to be stronger. Interest rates also play a key role. Central banks like the Federal Reserve in the United States set interest rates if a country has high interest rates. It can attract foreign investment. This increased demand for the currency makes it more valuable. Conversely, low interest rates might make a currency less attractive to investors. Economic growth is another factor. A country with a strong, growing economy often sees its currency appreciate. That's because people want to invest in successful economies, increasing the demand for its currency. But if an economy slows down or goes into a recession, its currency might depreciate. Political stability is also crucial. Investors prefer to put their money in countries where things are calm and predictable if a country is politically unstable. With lots of changes or even unrest, investors might pull their money out, weakening the currency. This is why countries with a stable political environment tend to have stronger currencies. Central banks play a significant role in managing their currencies. They use monetary policy tools to control inflation and influence exchange rates. For example, they can raise or lower interest rates or buy and sell their own currency in the foreign exchange market to stabilize its value. These policies directly affect the economic landscape and subsequently the financial landscape. Then there's purchasing power parity, or PPP. It's a way to compare how much things cost in different countries. Imagine a basket filled with the same items in both the US and Japan. PPP tries to figure out what the exchange rate should be so that the basket costs the same in both places. It is not a perfect way to calculate an exchange rate, but it gives one an idea of the relative value. The balance of trade also affects currency values. If a country exports more than it imports, that means more demand for its products. Its currency tends to strengthen. That is because other countries need their currency to buy the products. If a country imports more than it exports, its currency might weaken. Don't forget about investors and traders. Their feelings and beliefs about a country's economy can also cause currency fluctuations. Speculators might bet that a currency will rise or fall, and their actions can push the currency in that direction because they are speculators and not trading based on any actual good or service, affect the market very quickly. Global market events like a worldwide financial crisis can also have a big impact on currency values during times of uncertainty. Investors often flock to what they see as safe havens like the US dollar, increasing its demand and value. Another factor that impacts the value is how much external debt the countries have and the ability to repay. The flow of capital in and out of a country also determines how it is doing in the financial end. Economic markets, foreign investment has a huge role to play if investors are investing more in a particular country. It will help give that country's currency the value boost that it needs. It goes back to principle number one, it drives up demand. So why do different currencies have different values? It's a complicated mix of inflation, interest rates, economic growth, political stability, trade balances, central bank policy, and investor sentiment, and other global factors. It's like a giant seesaw. With all these forces pushing and pulling on currency values all the time, there is no simple answer. But all of these things affect currencies and are the answer to why do different currencies have different values. However, predicting short-term exchange rate movements is difficult because unforeseen events, like political shocks or unexpected economic news, can quickly change the direction of the market, leaving the rates in a different form. That's an unresolvable problem that we haven't yet figured out. How to predict those short-term events accurately. If you found this explanation helpful, please like, share, and subscribe to our channel for more videos like this.